Hello my fellow freedom builders and welcome back to the channel. It is almost at the end of the year 2020 and what a year we have had. Now I have taken a little break from video making here over Christmas, but I'm back now and I thought I would make a little video about some concerns I have about the market. Because, well, the title here, Permanent Bull Market, and then a question mark. And then I put Sir John Templeton in. He is famous for this quote here, that the 4 most dangerous or expensive words in investing are, this time it's different. And this quote, this time it's different, I have met several times over the last couple of weeks. People saying it in Facebook groups. I've seen it in a couple of articles written by financial journalists. All of them arguing that we are now in a financial regime, in a market regime, where we have almost zero interest and therefore this time it is different. We are at a permanent level of low interest rates, so therefore we are following the TINA concept. TINA is short for there is no alternative, so people will keep pouring their money into the market. And I kind of agree. I can easily follow the logic behind it, and I am also buying myself right now, so this is not some sort of the crash is near and the sky is falling video, not at all. However, I'm certain that in the comment section afterwards, I will see some comments saying that I'm always preaching a big crash, but I'm not. And as I said right now, I am buying stocks because I'm a trend follower. So when things go up, I tend to buy. However, we need to be careful and we need to know the history of the stock market because things are not different. Maybe there are some different aspects. Yes, we have historical low interest rates and so on, but the basics and the human emotions in the market is exactly the same. I saw another version of this one, and that is the bull goes moo, the bear goes grrr, the lemmings go, this time it's different, or it's different this time, but that's basically the same. So people will get hurt at some point in the market. I'm a big fan of following the trends, but I will show you something today that at least I'm not trying to persuade you not to invest. I'm trying to persuade you to be careful and to be able to look for the warning signs in the market. So let's have a look. First of all, I'm not in any way affiliated with Amazon or anything, so it's not that I'm trying to sell you something to earn a profit, but I do recommend that you go in here and have a look at this book. It's called This Time It's Different, 8 Centuries of Financial Folly. And well, you kind of guessed it. They looked at 800 years, 8 centuries of financial history. And you know what they found? There's pretty much nothing different. But the funny thing is that in every single cycle in the stock market, or at least in the late couple of hundred years where we have some records from it, from newspapers and so on, we find this quote over and over again, maybe 6 months or a year or 2 years before a major crash. People keeps thinking that this time it is different. I think I mentioned it in one of my videos where I said that the Ford factories back before the crash in 1929, they had to hire some people to write on blackboards, to write the stock prices and the fluctuations over the day. Otherwise, they were not able to get the factory workers into the factory to actually produce cars because people knew that it was a lot more profitable way of living just to stay at home or go down to the stock exchange and to trade stocks. So already in 1929, people had this idea that things are in a permanent bull scenario, and the newspapers from 1929 are full of quotes like this, that we have now entered the time of technology and nothing can give us another bear market, and so on and so forth. So I'm just trying to say that if you have convinced yourself, or if you are listening to other people saying with all sorts of logical arguments that with this low interest and with this technology we have today and so on, and Robinhood accounts and stimulus checks and so on, we could impossibly face another downturn in the market. Well, be careful thinking that, because of course we could. Let me show you a bit of stats here. First of all, I'm going to show you this one. This is a graph showing you how much margin debt is used in the market, meaning how many billions of dollars are borrowed to be put into the market, meaning that people are investing for borrowed money. And what we can see here, the red line is an inverted curve. You can see here billions, and it is going up while it's going down. So the amount of billions of dollars here is growing when we are going down the graph here. So what we can see when this red line is dropping, it is actually that more and more billions of dollars are spent on margin to into the market investing. And what we can see is that the higher the leverage, the steeper the drop, because when the market tops, and it is not because of the margin, but it is some sort of external trigger event that triggers this drop in the market, and the market might have been a bit overpriced, but all of a sudden when it starts to drop, people start to get margin calls, meaning that they are forced out of their positions. If they cannot put more money into the account, then the broker simply closes down the position. So that forces a lot of stocks into the market, and it forces a big sale, a big fire sale here. So as you can see, the stock drops, and of course the margin debt drops as well, because the brokers are bringing down the level of margins, and then it starts growing again, and as does the market. And at some point, this was in the dot-com crash, this was in the financial crisis in 2007 and 8, where we can see that when it started to top off, we started to get margin calls, and people got nervous and they didn't want to use margin anymore, and that just sped up the speed of the drop here. So what can we see now? Well, we can see that over since 2007, 8, 9 here, we can see that the stock market has pretty much just gone up, and the margin debt has kept growing and growing and growing. And of course, I know that this is partially due to the very low interest, because that with low interest we have pretty much free money. So we can borrow money at 0 or 1%, and then we can put it straight into the market and make a lot of money. As I have told you in a lot of videos, it is only a matter of time. I know that the central banks, they are determined to keep the interest low, but we can also see both in Europe and especially in the United States that the prices are starting to go up. The hidden inflation is starting to go up. And at some point, when the money lenders are realizing that there actually is some sort of inflation of maybe 2 or 3 or 4% in the United States, then we will see a demand for higher interest rates, and then we could see a fire sale here on the stocks as well. Right now, the level of margin debt is going up, so that is pretty much just enforcing the bull market. The more margin debt, the more a bull market, because all of these billions of dollars are pumped right into the market by retail traders again, maybe even by the lemmings here, because of course this time it is different, as you know. And at some point, and I am not trying to predict when, but at some point when we'll see a turn, and we will see that maybe in a week, maybe in a year, maybe in 5 years, I have absolutely no idea, but when it happens, it will go very, very quickly, because we are up at an amount, a record level of amount here of maybe even 730, 40 billion of dollars put into the market of pure margin. Now, how large is the market? Well, an estimate says something like $30 trillion, and you might say, yeah, well, then 700 billion is not that much, is it? No, it might not be, but just remember that out of these $30 trillion, that is the total market capitalization, but just remember that a lot of these stocks are locked into different funds. They are not all floating in the market, so it might only be maybe $10 trillion. I don't know the exact amount, but it is a lot smaller, the amount that is actually floating out that you and I can trade on the stock exchange. So just remember that, so that the $700 billion might be a lot larger percentage of the overall market than you might think. I just found another article here, and I do recommend you following this Molding Economics here. You can read it yourself. I'll not go completely into details with it, but what they're looking at is the history about how long time the market can stay overvalued. And I know we are talking a bit about the fundamentals here, and I am mostly a technical analyst, but I do like to look somewhat at the overall fundamental level of the market. So what we can see, first of all, is of course the Fed, their balance sheet here. That is how much debt they are producing, or how much bonds they are buying, you could say. Total assets here. And what we can see here, of course, with the virus crisis we have had this year, is a complete explosion in the amount of debt. And that, of course, have helped the stock market as well. There are some stimulus packages right now where they're getting in United States some $600 extra, maybe even $2,000. Nobody knows at this point. So the president just signed the agreement, so that is great. But it'll just lead to more debt here. That is not really the point here. We can see all of the central banks are exploding their assets here. What is interesting is the S&P 500 valuations. There are, I know, a ton of different ways to see if the stock market is overvalued. And here are just a few. Yeah, the median EV to sales, that is the enterprise value to sales here. Most recent value is at 4.0 score. That is in the 100% percentile, meaning it is in the absolute top of what it has ever been. Now, is this the only point that shows us some very expensive stocks? Nah, we have some US total market cap to GDP in the 100% percentile, EV to free cash flow, 100% percentile, median price to sale, 100% percentile, median price to book, 100% percentile. Should I go on? I don't think I need to. We can see that actually down here we have some aggregate price to book at only the 91%. The 91% percentile here, and we do have some cyclical adjusted PE that is only at 97 and so on. But I think you get the picture here that this is some crazy numbers, and I'm not saying that this could not go on for a year or 2 or 5. So I'm sticking to my strategy and I keep buying, but you just need to be aware that levels like these, we need less and less of a trigger to trigger a downturn in the market. So if all of these were only at a 25% in the historical percentile, then there would be a lot less excuse to simply make a fire sale of your stocks. But when they are at the 100% percentile here, then most investors, or at least many investors, professional investors, are staring at these and they are looking for excuses to sell, not excuses to buy. So as I said, it might go up a ton of years. I remember back in 2006, all the signs were there that the market were going to crash, and I actually sold some of my stocks. I was not completely faithful to my strategy, and we did see some of the same valuation numbers as we do right now, but the market kept going for a year and a half more, and then the crash came. It really hurt, but I'm just saying that things are not different. Times are not different. No, they are exactly the same. But no one can predict when a crash is coming or how big it will be. So again, I'm not trying to be some sort of perma bear here. I'm just saying, be careful and don't get lured into this borrowing money on your house simply to put into the market, because of course it could never go down. It can always go down. And if you're using borrowed money in your house, maybe on a flexible interest right now at 1% or 2%, then you borrow $1 million in your with your house as collateral, and all of a sudden the stock market tanks and the bank is coming for your house, or the interest rate goes up to 4 or 6 or 8%, so you can't pay the interest. Everything can happen in the market. So I'm not opposed to investing, but I really, really urge you not to go out and borrow money like crazy to put into the market, because it can only go up. Right here we can see the United States S&P 500 price to operating earnings, meaning the average PE ratio in the S&P 500, and we can see right now we are at the same level as we were back before the dot-com crash here, during the dot-com crash, and actually just around the financial crisis in 07-08, we were not even at the same levels here. I know that one of the reasons why this is very high right now is that the prices dropped this spring here, but they have gone up, and the earnings, I think, as we'll see here in the estimates just in a second, we can see here the S&P 500 forward PE ratio, as it says here. The next chart, courtesy of Jim Bianco, shows the forward PE ratio, which means it looks at Wall Street's consensus expectations rather than what it has actually happened. So this one up here is what actually has happened, and this is the expectations. And what we can see right now is that we are at an insanely high level, and in the last 25 years we have only seen similar levels just up to the dot-com crash. But remember, it kept going for a year or a year and a half from these very high levels before it crashed, so maybe we have a lot of time more ahead of us. In this article, you can look in a lot of graphs here, and I know you might also be able to find some graph that are showing the opposite. I'm not saying that you can't do that. In the end of the article here, we have a paragraph called Market Psychology, and that is very interesting to look a bit at the overall psychology in the market. And as it states here, bubbles typically end with some huge corporate collapse, often tainted by fraud. That is, well, you can see here Enron, Lehman and Bear Stearns. They are some huge collapses, and we will see that in the next collapse, whenever that will happen. Bubble dynamics need not bear any relation to the strength or weakness of the overall economic cycle. So that is true. As we can see right now with stock market, it doesn't really have any connection to the overall economy. And as we can see, speculation increases dramatically when prices break through major highs. And that is simply because people are getting more and more convinced that this can only go one way, and that is up. And that is when we see these huge spikes in the use of margin debt. So what I'm saying to you here, guys, is be careful. I'm not saying not to invest in the market. Myself, I'm almost 100% invested in my normal stock portfolios, and in my ETF portfolios that we are starting the fund with right now. They are 100% invested all the time. They are up something like 41%, almost 41% here in 2020, and that is without any leverage whatsoever, simply just using our rotational ETF strategies. So the ETF strategies have beaten my own stock strategies this year, 2020, a lot actually. And with some reasonable low drawdowns of around 15%. So that is great. I am almost 100% invested in all of my different portfolios. So I'm not so scared that I'm running away from the market, but I am definitely not using leverage. And I am on the lookout for different triggers, so that, for instance, in the spring when the virus came along, I was very quick to draw out of the market. I withdrew my money and only took a drawdown of around 11-12% on my Scandinavian portfolio. And that was partially due to the fact that I knew we were in an extremely overvalued territory. So I was ready to pull the plug. But again, in the end of March, I started to get buy signals, and even though it was a mentally hard exercise for me, I started buying like crazy again in March because my models told me to, and that has made it a very good year for me. But I am careful, I am cautious, and I am looking for the next triggers, but I'm not selling in panic. I'm using my strategies as always. So that was a bit of a New Year warning. I don't hope I put you into too much of a bad new year mood here, because I actually think that this spring of 2021 and maybe actually all of 2021 may be a very good bull market. We don't know yet, and those trying to predict it are normally wrong. But I expect a lot of buying pressure again because of the low interest and so on. But we can never be fortune tellers, and we can never tell what will potentially crash the market in 2021 or 2022 or in 10 years from now. No one can tell you when it will happen or what will trigger it. But what scares me a bit is that I can see a ton of analysts right now coming up with all sorts of logical arguments why a crash could never happen right now. And the irritating part is that the crashes often happen when most experts are logically convinced that it couldn't do so. So that is my warning for you here for 2021. I might be making a bit less videos in 2021. I have been making a couple of hundred this year, and I might only be making, let's say, 100 videos in 2021. I will be using a lot of effort on building our new investment fund here in Denmark based on ETFs. And yes, also the Danish subscribers is getting a lot of my time and effort right now. But I will be here on the channel, and you will get a video once or twice per week. And you are, as always, welcome to ask me questions on my Facebook site or in the comment section below. That's all for now. Take care of yourself and your money out there. And I'll talk to you again when we have entered 2021. Bye for now.